Hello, students. Today we begin our discussion on banking and the Reserve Bank of India. In this first part, we will cover four main areas: the concept of money, the basics of banking, the evolution of banking in India, and the different types of banks. This background will help us appreciate how the Reserve Bank of India works, which we will take up in the next part. Money is defined as anything that is generally accepted as a medium of exchange, a measure of value, a store of wealth, and a standard of deferred payments. This means money is not only currency notes and coins. It can take any form that people widely accept for trade and transactions. Money performs four key functions. Medium of exchange, it replaced the barter system where goods had to be directly exchanged. Measure of value, it allows us to assign value to goods and services. Saying that a notebook costs 50 rupees is a measure of value. Store of value, we can save money today and use it tomorrow. Standard of deferred payments, loans and credits are settled in terms of money at a later date. Money has appeared in many forms. Metallic money like coins. Paper money, that is, currency notes. Plastic money such as debit and credit cards. Digital money like UPI, mobile wallets, internet banking, and even the central bank digital currency or digital rupee. Now let's turn to banking. A bank is a financial institution that accepts deposits and lends money. It ensures financial security, creates credit, and supports economic growth. In today's world, banks are not just money keepers, they are service providers connecting savings and investments. Banks perform several functions: accepting deposits in the form of savings, current, fixed, and recurring deposits; granting loans such as personal, housing, agricultural, and business loans; facilitating payments and transfers through checks, NEFT, RTGS, IMPS, and UPI; promoting investments like insurance, mutual funds, and securities; extending financial literacy and inclusion, especially to rural and semi-urban areas. Banking in India has a long journey. The first bank was the Bank of Hindustan in 1770. Later came the Presidency banks: Bank of Bengal, Bank of Bombay, and Bank of Madras. In 1921, they merged to form the Imperial Bank of India, which became the State Bank of India in 1955. In 1969, the government nationalized 14 banks, and in 1980, another 6 banks. This expanded banking to rural areas and promoted social development. Today, India's system includes public sector banks, private banks, regional rural banks, cooperative banks, payment banks, and small finance banks. First, commercial banks. These are the familiar banks that provide loans, accept deposits, and offer services to businesses and individuals. Second, cooperative banks owned by members, often farmers and small traders. These banks focus on agricultural and rural credit. Third, regional rural banks, established in 1975, were created to support rural development. Fourth, development banks provide long-term finance for projects. Examples are NABARD, which supports agriculture, and SIDBI, which supports small industries. Fifth, payment banks. These are limited banks that can accept small deposits and provide basic services. Examples are Airtel Payments Bank and Paytm Payments Bank. Sixth, small finance banks. These serve small businesses, low-income households, and farmers. They are an important tool of financial inclusion, bringing banking services to people who were earlier outside the system. So students, in this part we studied the definition and functions of money, the forms of money, the functions of banks, the history of banking in India, and the different types of banks. This sets the stage for our next session, where we will look closely at the Reserve Bank of India, its functions, modern banking services, and its recent initiatives. Jai Hind!